My name is Jake, welcome to the channel. In today's video, we're going to do a Review My Pie video where I review subscriber portfolios. I love this series on the channel. I talk mostly about dividend investing. About every couple of weeks or so, I do a Review My Pie video like this. I've been doing this for, I want to say, about 3 years now. This is the 47th episode of this series, and I absolutely love it. So it's very different than the other content on my channel. But if you're new to the channel, once again, my name is Jake. My wife and I, we live down here in Austin, Texas with our little baby boy. His name is Lucas. He's 2 years old now, and we're pursuing financial independence. And, you know, that's really been the goal here these last couple of years. I've been investing for about 15 years. I've made a lot of mistakes. There's a lot of things that I've learned along the way. And I created this series to help other people like you so that you don't have to make those mistakes that I made. So that's really the reason for this series, and really the goal is to help other people. So in today's Review My Pie, I'm going to answer a subscriber question as well as review 3 portfolios. The first is going to be from a 26-year-old here in the US, the second a 37-year-old from the Netherlands, and then the third a 19-year-old from the United States. I try to have a mix of different ages here, so if there's not an age here that represents you or what you're interested in, you can check out some of my other videos that I've made here on the channel. As always, there's going to be the timestamps in the description as well as the portfolio links, if they're provided, will be in the description as well. And as always, everybody, I'm not a financial advisor. This is just merely for your entertainment, so please don't take what I'm saying as professional financial advice. So as I mentioned, I've been doing this for about 3 years now or so, and I've kept the format so similar over these last couple of years. And I was thinking to myself, you know what, I'd like to spice things up a little bit. And if there's interest, I'd like to provide a way for you to kind of like dial in or to send a recording of a question that you have. So in the description below, I will leave a link, Ask Jake a Question. You can click on that link and it'll pull up this page right here. It's not an affiliate page or anything like that. What you can do is you can record your question, or you can submit your portfolio and you could add your own commentary. Instead of writing out a long email, you can record it, and that way it'll save you some time. You don't have to write the email, and then we don't have to listen to my voice the whole time. And we can hear from some of you to spice things up a little bit, get a little bit of a different environment, different experience here. And so if you're interested in that, you can submit a question or you can send in your portfolio. You don't have to use M1. You can use any portfolio, any brokerage out there, and you can submit it here, and I will definitely consider it for a future video like this. I also built a site where if you want to book time with me directly, you can do that. Now, when I create these YouTube videos, I try to make it as personalized as I possibly can, but obviously everyone is in a unique situation. If you are, really looking to speak with somebody about your portfolio or dividend investing or something, everything in between, I do this a couple of times a week. I'll leave a link in the description below. You can book some time with me directly one-on-one. I do it through Google Meet. So, I share my screen, I share my video, everything like that, if that's something that you're interested in. And here, very quick, the last thing here is I am an affiliate of Seeking Alpha. They're not sponsoring this video or anything. I just got a notification from them that the 58% off will be going away starting after May 21st. So if you're looking to sign up to Seeking Alpha Premium, you can use my link. You'll get 58% off. It'll be $99. Starting May 22nd, there will be no discount anymore. It'll go up to $239. So if you're looking to sign up to Seeking Alpha Premium, definitely support the channel, and you'll get a better price using my link. So, but as always, no pressure. Thank you so much. I appreciate it. So before we dive into the video, I want to share a brief documentary that I have created that depicts actual events going on in the world today. And I prepared this for you, put a lot of love and heart into it. And it looks a little like this.
Pam? When will the new copier be ready?
I'm working on it, Kev.
You said it would be ready by today, and it is today.
It'll be ready soon.
Soon could mean anything. Soon could be 3 weeks.
Is that what soon means to you?
Sometimes.
Then come back soon.
Oh my gosh. Oh man, I love it. I love it. All right, cool. All right, everybody. So let's take a look at the first question here from Ryan. He writes, "Good evening, Jake. My name is Ryan. I'm 21 years old, 22 on Wednesday." Oh, congrats, man. I'm sure you're already 22 now since you sent the email. You're living in Pennsylvania and you're looking to retire by the age of 45 or earlier. I've seen almost all of your videos and the value and information you provide to me and the rest of your reviews is absolutely astounding. Keep up the great work. Ryan, thank you so much, man. I appreciate you saying that. With that being said, I had a question about your video, how to pay zero taxes on your dividend income at early retirement legally. Would it be possible to use some sort of tax loss harvesting strategy in a taxable account to offset the amount of qualified dividend income that is counted towards capital gain tax? Here's what I am thinking. Okay, let's take a look. So I did not know much about QLD because I know as a 21-year-old, I should be focused on growth and not income, but it looks as though it's somewhat of a depreciating asset where it is slowly losing value over time. If I bought QLD right before retirement, I could receive the ordinary dividend up to the standard deduction, so it's tax-free. However, once my dividend income goes above the standard deduction limit, I would sell off some shares of QLD, and this would theoretically accomplish three things. I would be shaving down my ordinary dividends to the standard deduction amount, so that's the first thing. Second thing, I would be selling those shares potentially at a loss since it appears as though QLD drops in price over time. And three, since I'm realizing the loss from QLD, it would count as a capital loss, which would allow me to bring in more qualified dividend income for that year. I'm not sure if this even would work or if this is a viable strategy, but I'd love to hear your thoughts. Thank you so much in advance. Well, Ryan, thank you so much for the question. I think you answered it to begin with. Well, a couple of things. First thing, when you say, I do not know much about QILD, that scares the heck out of me. Why would you ever invest into something that you don't understand? What that tells me is you might as well just go to Vegas and just gamble. That's what it sounds like. Why even bother rolling the dice, investing when you could just go to Vegas? That's essentially what you're doing here. If you don't understand what you're investing in, there's no difference than just going to a horse race and picking a horse out of them and just betting on whatever. I guess you already answered the question in here that you're 21 years old and you should be focused on growth and not income. A couple of things that come to mind. You're not wrong when you say all three of these things. You're not wrong. You can absolutely do that and it could likely, work out. But here's the thing. The one thing that you're missing is you're missing what's called the opportunity cost. The opportunity cost is what could have happened had you invested more for growth. The opportunity that you're losing here is just, it doesn't make it worth it. It really just doesn't make sense to forego the opportunity to make a lot more money, especially while you have the greatest asset, which is time. That's your greatest asset. That's what you have, what I don't have. And that's why in almost every case, it would be better to focus on growth. So a lot of what you're trying to do is timing and the tax loss harvesting, it can work. This strategy would be better if you're very nearing, you're nearing retirement and you're thinking, okay, how can I produce income? As a 21-year-old, you want to focus on how do you build wealth? And what you're talking about here, this is not a wealth building strategy. So that's why I would throw it entirely out the window, just throw it out and think about how can you build wealth? And that's what you should be focusing on. You shouldn't be wasting your time, in my opinion, thinking about how you can kind of hack this with maybe making a couple of dollars here or there. That's not going to move the needle. That's not going to create generational wealth for you and your family. That's not going to level up your life, right? You want to think about how can you build wealth, and that strategy here with QLD is not the right approach. I'm not saying that you can't do it later. You could always consider it later, but right now as a 21-year-old, you want to focus on investing in yourself, making sure that you're putting yourself in a position for a higher, to make sure that you're making more earned income. Unless you're an entrepreneur and you're Gary Vee or some crazy, finance guy on YouTube, like you want to be focusing on how can you make more money. That's through your job, through investing in yourself, getting educated, getting qualified, certified, invest in yourself, invest in your education, invest into your financial literacy and understand what you're invested in. That's how you build wealth. It's not through, tax loss harvesting shenanigans when you're 21 years old. Not just for you, Ryan, everybody out there who's in a similar situation, stop looking at these covered call ETFs. Stop it. I beg you, don't do it. Focus on building wealth. Covered call ETFs their purpose is not to build wealth, is to generate income. And you need to understand what situation are you in. Are you looking to build wealth or to generate income? All right, let's take a look at the first portfolio from John. He writes, "Hey Jake, just wanted to say I appreciate all of your videos. I'm 26 years old from the United States and I'm investing for dividend growth and for early retirement. I just started with M1 Finance and built this pie. I think it's pretty solid. I saw you said to have mostly ETFs and I also have some real estate diversification, which I like as well. Wanted to know your thoughts on my portfolio. Also, sorry if the email format is bad. Thank you." Okay, so John, appreciate it. So you're 26 years old. You want to retire as quickly as possible. You probably, have seen some other videos of mine or other YouTubers out there about financial independence or, dividend investing. So that's I don't have your time horizon. I don't know if it's 10 years, 20 years, or 30 years, but I'm going to assume that it's 20 plus years. And that's relevant because everything that I say is based off of, your time horizon, when you plan on living off of your dividend income. So let's take a look at this. You have your portfolio here. It's up 53%. You have a low expense ratio. I like that. You have a decent dividend yield. I actually like this. You're 26 years old. Depending on when you plan on living off the dividend, this could be a little bit lower to begin with if you wanted to, but it's not bad. It's not bad. So let's take a look and let's see what you have in here. You've definitely followed my feedback from some of my videos here recently. You got SCHD at 45%. You got VNQ at 5%, VGT at 5%, VOO at 5%, DGRO at 5%. Okay, I like that. And then you have some individual companies. I'm assuming these are some of your favorite companies. Maybe you're a consumer of them or you've done some research on them. I like that. I like it. Some some good brands in here. This is a really, really solid portfolio. It's a very conservative portfolio. Very conservative. You may want to consider, a couple of things. Okay. First off, it's very conservative. Depending on your time horizon, can make a massive difference if it's 10 years, 20 years, or 30 years. I would encourage you to look for ways that you can maybe generate a little bit more oomph, a little bit more growth in the portfolio. That could be increasing your percentage to DGRO and VGT, for example. That would ump up the oomph in it, I guess you could say, because these are very, very conservative investments, which is a good thing, which I actually like. The next thing that I would say is the REITs. In my opinion, why are you holding the REITs in here? You got 2, 4, 6, 8, 10% in REITs. Plus this, you got 15% in REITs, which is not bad. The question is do you have a Roth IRA? Could you put those REITs in a Roth IRA? Like, what about, like, here, I want to give you something to think about. Now, imagine, so you're building this portfolio. You're 26 years old. You want to retire as soon as possible. You probably got a crappy boss, probably had a bad day. You're like, you know what? I want to retire. I want to stop the rat race. I've been working for 2 years. I'm done with it. Right? I'm sure your parents are like, oh, you poor soul. You're still very, very young. You're still going to figure out a lot of things of what you want to do in life. What I would recommend is see if you can optimize this just a little bit more, and maybe you could either lower your exposure to real estate in the beginning for the first couple of years, or transfer it over to a Roth IRA. Okay. In my opinion, I would first transfer it over to a Roth IRA. If you don't have a Roth IRA, me personally, I would limit the exposure to REITs. It's just, in my opinion, you don't really need them right now. And then what you could do, let's say, you're 10 years down the road and you're like, okay, in 3 years, I'm going to retire, and that's your date. Then what you do is a couple of years before, you start slowly adding them. Okay. And so you're not paying the elevated tax all the way, but you're adding them later, and you're being a little bit more strategic with optimizing your taxes there, right? And the growth of your portfolio. Okay. So those are my thoughts there. Another thing that you could do is, right, you got VOO and you got VGT. You could add, like, you could put like 20% in VGT or 15 and 15 in VOO. And then later in 20 years, you could rebalance the portfolio. You could sell a portion of these higher growth ETFs, which should be at a higher value in the future because their growth, right? Growth generally grows faster than value. And then you could always reposition into these other higher yielding dividends. And you'll accomplish a couple of things. One, you'll accomplish by having a higher total return because your appreciation, the capital appreciation plus the dividend will be higher, and you'll pay less in taxes. So in my opinion, that's most likely, without having a crystal ball, it's most likely your best bet. But as all in all, I like it. It may be a little bit too conservative, but I don't understand where you're currently at. Are you 3 years out, 5 years out, 20 years out? So that's something to definitely consider. Yeah, I hope that helps. And thanks for sending over your portfolio. All right, the next portfolio here is from Dennis. The formatting in the email was a little bit off. It made me scroll left and right. So I just wanted to copy and paste it here so I didn't have to scroll left and right to see the whole text. So he writes here, first off, thank you so much for your content you create on your channel. I've learned so much from you. I watch a lot of channels, but the Review My Pie videos are my favorite. It's great to see the choices of other investors make and the tips you provide them. Hey, man, thank you so much. I appreciate you saying that. I'm Dennis, a 37-year-old from the Netherlands. I live here with my 2 and soon to be 3 children and my lovely wife. That's exciting, man. I am self-employed, a financial controller, and have a good income, which allows me to have significant amount left over for investing. Thanks to your channel, I've become very enthusiastic about dividend investing and started my portfolio a year ago. I've noticed that it is challenging for me to stay focused on a select number of companies, especially during the first month when I was more like a collector of stocks. I read and consume a lot of content about dividend investing, and I find that it often distracts me. Man, you're not alone there. I have a time horizon of 20 years, and my goal is to be able to live off dividends by that time. I'm wondering if it would be wiser to invest more in growth ETFs or the dividend stocks ETFs. When I look at ETFs like SMH and VGT, they have had much higher total returns over the past 10 years compared to, for example, SEHD. So why shouldn't I invest most of my money in stocks that have a higher total return instead of focusing on SEHD or dividend stocks like Lowe's, Home Depot, Starbucks, etc.? Currently, I am doing both, but have not yet determined a fixed allocation for the positions I want to hold. I think it might be a good idea to have 50% in ETFs and the rest in individual stocks. I'm a nerd and love everything related to stocks. It is important to mention that in the Netherlands, we pay a dividend tax of 15%, but this tax can be offset against the capital gains tax. As a result, no tax is ultimately paid on the dividend. I would appreciate hearing your perspective on my question and my portfolio. Thank you so much. Kind regards, Dennis. Well, Dennis, there's a lot to unpack here. Thank you so much for the kind words. I'm excited for you to have your third child here. That's very uncommon in Europe. I know that. So having kids in the Netherlands, that's amazing, man. So right off the bat, I think you're spot on when you talk about focusing on total returns. That's what every investor should be focused on, is where are they going to get their total return depending on where they're at in their stage of life, right? Are you in a wealth accumulation mode or are you in wealth preservation mode, right? Whenever I hear a 21-year-old talking about investing in gold, I always just like face palm, right? Like, why? Are you trying to preserve wealth? Like, they have all of their net worth in a little thing of gold, and I'm just like, dude, come on, right? Unless the world's going to end, I don't know, right? So I don't have a crystal ball, but focusing on total returns is spot on. And I think you actually answered in your email what I was going to suggest. And that is, whenever you're on the fence, and I noticed this with myself, okay, exactly what, everything that you just described, I experienced myself firsthand. Okay, whenever you're faced with a question where you don't know the answer, in my opinion, in my experience of doing this for a handful of years, is to don't take an all or nothing approach. Don't go all in on high dividend stocks. Don't go all in on growth stocks. Take a balanced approach, right? And that's why I love the core and satellite approach to investing is it provides flexibility. You can do, 50%, 60% into ETFs, and they can be growth ETFs, high dividend yield or dividend growth, or you can have a combination or a balance of both. And you can do the same with your individual stocks. So if you ever find yourself going back and forth and frustrated, the very first thing that I would tell you from personal experience, what helped me the most was don't think about this in absolutes. Don't think about all or nothing. Think about how can you set up a balanced portfolio that will get you more or less to where you feel comfortable and your ideal direction of what you want the portfolio to look like. It doesn't have to be perfect. And that's where the OCD in me kind of kicks in, where I think it has to be all this or it has to be all that. No, it doesn't have to be that way. Okay. Taking a balanced approach is absolutely fine. And it gives you a lot of options and flexibility. All right, so let's take a look at your portfolio. It's allocated here based off of, I'm assuming, your weighting in your portfolio. Your largest is Starbucks. You probably are a fan of PPC Ian. Ian's like, I think is his largest position now is Starbucks. That's awesome. You got SHD, Union Pacific, Lowe's, Texas Instruments, Visa, Broadcom, Comcast, Realty Income, NextEra Energy, Snap-on, United Healthcare, Home Depot, Pepsi, Johnson & Johnson, Williams-Sonoma, ADP, SMH, and VGT. Okay, so first off, you have some blue chip names. You don't have a lot of speculative growth companies or anything in there. So that's why I always talk about the combination of SHD and DGRO as the simple path to wealth, because you're getting the best of both worlds. SHD, you have a little bit more of a concentration on more established blue chip companies. Like, for example, Verizon is now one of the largest holdings in SHD. It's what? Verizon? Whereas with DGRO, you're getting much higher higher growth companies like an Apple or a Microsoft, for example. And when you combine them together, in my opinion, that's like a match made in heaven, right? And so to answer your question, I think going 50%, you could go 50 all the way up to 80%, and you could always adjust that percentage as time goes on. You said you have a 20-year time horizon. There's nothing wrong with adjusting it up or down based off of your risk tolerance. You really learn something about yourself as an investor in a down market. When the market is going down each week, each month, you learn about yourself and your emotions and how well you do with that. So depending on your risk tolerance, you can have a higher or a lower percentage allocated to ETFs like SHD or DGRO or VGT. And then you can kind of balance it out with other dividend growth stocks. But here's the thing, I kind of mentioned this earlier in a previous one. It sounds like, if you were to take a balanced approach, what you could do is you could follow the core and the satellite approach, where 80% of your portfolio or 70% is focused on your core, and you're never going to sell those, right? That's your buy and hold forever, right? That's your SHD, that's your DGRO, and maybe some of the other, companies in here that you really like, for example. The other satellite positions could maybe be 10, 15, or 3, or whatever percentage, but you could also include growth stocks and growth ETFs in there focused on the total return. And then in 20 years, you take those satellite positions and you rebalance them. And then you repurpose them into other assets, whether that be buying a home, buying a car, paying for your kids' tuition to go to college or whatever, or buying higher dividend stocks and ETFs. So that's why I like this approach, because it gives you flexibility and options, and you're planning accordingly. Okay, so once again, it doesn't have to be all or nothing. And that's what I would recommend if you're on the fence like this, to consider something like that. In terms of your companies in here, I think they're fine. The tax advantages that you have in the Netherlands is absolutely amazing. So yeah, that's great. So that's my feedback there. I hope that helps, and I hope that kind of gives you new perspective on how to look at this, or how you could look at it. Thank you so much for sending over your portfolio. All right, the last portfolio is from Lewis. He writes, "Hi, I'm 19 years old, currently attending the University of Texas at Austin, majoring in chemical engineering. Coming from Fort Worth, Texas, living here in Austin is not cheap. I know that because I live in Austin. Currently, I contribute to an individual taxable account and a Roth IRA. Given my age, I plan to invest for a very long time, and hopefully in the future, I'll be able to contribute more to my investments. My taxable account holds individual stocks that I believe are compounders, and my Roth IRA is an automated account with ETFs. Regarding the individual account, I feel like 31 holdings is too many, and I'd like to have a more concentrated portfolio. However, I don't really know which companies to let go since they have all mostly performed very well to the market. Maybe I can trim the consumer pie. The Roth IRA just continue to grow itself. You can ignore the 1% in VNQ because I plan on selling out once I break even. I just feel like the ETF trades with how the economy is doing, and I would like to minimize that exposure. Okay, thank you so much for informative videos. Here's the links. So I'm not the biggest. So a couple of things to unpack here. I just feel like the ETFs trade with the economy, how the economy is doing, and I'd like to minimize that exposure. In my opinion, I would think about that in the opposite direction. Getting market returns is actually, most active managers on Wall Street cannot outperform the index. And that's what you're talking about here. So in my opinion, if you've watched some of my videos, I am very, very bullish on the economy and in index investing, which follows the economy, because you don't have to pick the winners. That's what's so difficult about investing, is we think we always have to pick the winners, and it's near impossible to do that. That's why I would definitely encourage you to kind of reevaluate the statement here, because I think most people would be much better off if they try to kind of mirror or try to get comparable returns to the broader economy, broader index, because that's historically outperformed actively managed portfolios. Okay, so if you didn't understand what I just said there, go and read up on Jack Bogle. Learn about Jack Bogle, the founder of Vanguard, and learn about index investing and passive investing versus active investing. And that will add a little bit more flavor to what I just said. So you're 19 years old. You have a long time before you likely are going to be living off of your portfolio. 19 years old here in Austin. Right now, you want to be focused on how do you build the very most wealth and not what is the highest dividend yielding stock. Okay, so you really want to focus on the total returns. And the total return, once again, is the capital appreciation. That's what you see on Google Finance and Yahoo Finance, plus the dividend. Okay, that's the total return. Okay, let's take a look at your taxable account. You have a very low expense ratio. I like that. You have a good dividend yield. So this is comparable to the S&P 500. It's not far off. 31 holdings is, depending on how much time you want to invest here, is not super crazy high. But let's take a look. You got consumers, tech, core, fintech. This seems very, very similar to like a Joseph Carlson. It kind of gives me makes me think of him here. So let's take a look at what do you got in here. You got Costco, Hershey's, Target, Pepsi, Lowe's, Netflix, okay, Home Depot, Procter & Gamble, and General Mills. All really great companies. Costco is fine. Dividend yield is fine. These companies are all consumer facing, so you're probably a consumer of these, which I think is fine. I like that you have more in Costco than, for example, in General Mills and Procter & Gamble. If you invest into like an SCHD or one of these dividend ETFs, you're going to get a lot of exposure to some of these companies anyways, right? The Procter & Gambles of the world and the Pepsis of the world. Okay, so that's fine. Tech, what do you got in here? You got Microsoft, Apple, Broadcom, Adobe, Google. This looks very much like Joseph Carlson's. Okay. Yeah, this is more focused on growth. Okay. Microsoft, Apple. Okay. What do you got in your core? SHD and BlackRock. Yeah, SHD is fine. Me personally, like having a core, I would much rather have another ETF than, a financial institution like a BlackRock. But that's just me. Fintech, banking, Visa, SPGI, T. Rowe, MasterCard. Okay. So focus more on growth. Healthcare, United Healthcare, Thermo Fisher, Johnson & Johnson, blue chip companies. I think these are fine. I guess the question is as a 19-year-old, like, what do you know about these companies? Like, where did you hear about these companies? These are, in not all cases, because of Johnson & Johnson, a lot of them are B2B. Like, where did you learn about these companies? And, how do you know how they generate their revenues? Do you know how they compete in their market? Do you know what their total addressable market is? Do you know what their competitors are? Like, how involved are you when it comes to these companies? If your answer to those questions is you don't know, then I would ask the question, why the heck are you investing in them? It comes back to, you don't know them. Why are you investing in them? So that's one of the dangers of kind of looking at other people's portfolios online and listening to other people's advice when you don't know something about a stock. And I'm making assumptions, right? I'm assuming. I don't know if this is the case. But when you invest into something that you maybe don't understand, or you're just hearing from somebody else, you're not going to have conviction in the stock. And when you see the share price go down, you're going to think the world is ending, and you're going to emotionally sell at the wrong time. And so I think this can be very, very dangerous, especially when you're 19 years old. But I mean, sometimes you have to learn by touching the hot stove, right? Waste management, great. Old Dominion Freight Company, interesting. And Union Pacific. Real estate, you got VC. This is 100% Joseph Carlson. Okay, restaurants, 100%. Like, is this Joseph Carlson's portfolio? Okay, here, let me share something with you. You're 19 years old. You're here in Austin. I'm in Austin too. Let me speak to you man to man. I don't like this for you. I don't like it. As a 19-year-old, I would argue that you probably don't know what the heck you're doing. And you probably went and you saw a really famous YouTuber and they're very successful, and you're probably, which is, not always the wrong thing, looking towards people that are successful and kind of copying what they do. There's not always something wrong with that. But I think what I would recommend you do is you first understand and learn about investing. Understand, it doesn't appear like anybody that who's 19 years old and goes and copies a YouTuber's portfolio doesn't know what they're doing. Okay? I'm just going to call it as it is. What I would encourage you to do, you're at the university, you're studying, this is a great opportunity for you to invest in you. Learn about this. Learn about dividend growth rates. Learn about time horizon. Understand what your goals are. Because right now, you're investing into someone else's goals. These may not be your goals. Okay? So understand first what your goals are, so that then you can build a portfolio that will meet your goals. Because right now, this is somebody else's goal if you take it from somebody else. So the companies in here, there's nothing wrong with them. They're absolutely fine. But I'm concerned that this is the right approach for you. Okay, so this is your taxable account. In my opinion, I would start slow. I would simplify this. And me personally, I'm not giving you specific advice, right? But me personally, someone in this situation, I'd start fresh. I would start over. I'd go back to the drawing board, and I would start with understanding what are ETFs, understanding different sectors, what is the difference between investing into a growth stock versus a company that has been around for 100 years that has a 5%, understanding what you're investing in, okay? And starting with ETFs. Okay, so let's take a look at your Roth IRA. Your Roth IRA, good expense ratio, good dividend yield. Let's see what you have. You have SHD, VOO, DGRO, VGT. Okay, so this is actually very similar to my portfolio. Okay, so I like this, but let me tell you why I like this. I like this because it's so simple, it's so straightforward. Now, if you don't know how the fund methodology of SHD works, that's the very first thing that you need to do is understand how fund methodologies work, right? If you invest into SHD, you are getting nothing but the index that SHD tracks. Okay, if that didn't make sense, that's where you got to start. Okay, so I don't know your financial literacy level, but I'm trying to make sure that from a beginner standpoint that you understand this. DGRO in here, SHD, Simple Path of Wealth is great. VOO, great. In my opinion, I think your taxable account should look similar to this. At least in the beginning. You could always later in life, as you learn more, as you define your goals of why you're investing, you could always build out your portfolio later. Because I promise you that you're going to second guess yourself as time goes on, and you're going to say, why did I do that? Why did I do that? Start slow, start with ETFs, understand these, and then as you start making more money, as you become more financially literate, which we all go through, right? Then you could look to adding individual stocks, okay? So that's my opinion there. But when it comes to VNQ, there's actually nothing wrong with having VNQ in here. For example, in my Roth IRA, I have about a 25-year time horizon with my Roth IRA. I have VNQ at 10%. There's nothing wrong with holding real estate in a tax-advantaged account. So yeah, Roth IRA, I think you're on the right track. With your taxable account, I would definitely consider going back to the drawing board. And I hope that feedback that I just shared is helpful. Thank you so much for watching, everybody. I know that we covered a lot in this video. I hope that it was helpful. I hope that you learned something new, and I'll see everybody in next week's video.
Please subscribe. Please subscribe.
You know what? I think we're gonna be friends. Can everyone say hi to my friend? That's crazy. I just wanted to say thanks. I'm glad you came along, partner.